Thanks for coming out this morning. I'm John Michael Huggins. I'm at the bottom of the list there. I'll be starting off today, and then Aaron Howard will speak to you, and then Charlie Harriman will wrap us up. See a lot of familiar faces. I'm sure most of you come to this every year. If we have any newcomers, if this is your first year, welcome. If you didn't get a pad and a pen, raise your hand if you need one and we'll get it to you. What we would ask is let us kind of get through the presentation. If something comes up and you have a question, jot it down. And then Charlie's going last. You can ask him all the questions you want. He'll have a perfect answer for all those questions, okay? So again, thanks for being here. We'll hop right in. And this chart isn't showing up well at all. But basically, what it should show is market performance going back for the last 10 years, okay? And out here, the moral of the story is last year the S&P made 17.86%, okay? That's the third year in a row that the S&P has made double-digit returns, all right? And what this chart should show you is that has only happened 3 times in the last 10 years, okay? Now, the last 2 times that it happened where you had 3 double-digit return years in a row, the 4th year was negative, okay? One was just a little negative. One was, decent 10 to 15% negative. So, does that mean this year's going to be negative? We have no clue, right?
Hey, he's going to try another computer.
Okay.
He doesn't know if that computer just is...
Keep going.
Okay. I didn't know if you wanted me to stop or not.
That works.
So, again, going back to what Don says, we don't have a crystal ball, right? We don't know. That's why we manage for risk first, okay? If it comes, we're prepared. If we get a 4th double-digit market year, we're prepared to take advantage of that too, right? So diversification and risk management. Now, last year, what is interesting is even though the S&P made 17.86%, 36% of the stocks in the S&P actually were negative. And it was worse in the Russell 2000 and the small caps. 46% of the stocks in the Russell 2000 actually posted a negative return. Okay? Now what's interesting is already in 26, we're seeing those numbers change. All right? And right now, the Russell 2000 is outperforming all indices so far in 26. Again, it's just a data point, but what we hope to see is these numbers go down, right? And then we get more performance broadly across that index. More strength equals more growth. But again, it's something that we want to keep an eye on as we move forward. So, as the chart says, the Magnificent Seven, not quite so magnificent anymore. But that's to be expected, right? Going back 23, 24, 25, especially in 23, NVIDIA was the market. If you own NVIDIA, you were killing it. Even coming back out of COVID, if you bought NVIDIA back then, any of these 7, your returns were way above what the S&P yielded. And you can see 24 not as good. In 25, only NVIDIA and Google, and it's carried over into 26, only NVIDIA and Google are outperforming the S&P 500. So does that mean those are no longer good investments? No, not necessarily. But consolidation is to be expected after you have consecutive run-ups like that, right? And we really started seeing that at the end of 25, where we started seeing the Magnificent Seven stall and even start to pull back as some of these companies in the Russell 2000 started becoming productive, okay, and posting significant growth. So what we're seeing is money flowing out of the Magnificent Seven and the tech sector in and of itself, and being diversified across the market, okay? What's that going to mean for the market, S&P 500, NASDAQ, the Russell in 2026? We don't know. This is just what we're seeing in the market, okay? Momentum doesn't last forever. Again, does that mean these are no longer good investments? This is just my personal opinion. I don't think that. But can we still expect to get the returns we've gotten in the past? No. Now, 17.86% on the S&P. I'm happy with that. Anybody else take 17% in an investment? All day long. That's right.
It don't matter.
But one reason why, a lot of that growth came out of the Mag 7 and out of the tech sector. One reason we diversify is because 2025, for the first time in over a decade, what we saw was that global investments drastically outperformed the S&P. So if you were just in the S&P, you did fine. But if you were diversified and had global investments in your portfolio, global actually did 30% in 2025. So again, going back, we want to diversify. We want to manage our risk. Going back to that first chart, we don't know what 26 is going to bring. Okay? Another key factor in 2025, y'all may not have heard about this, was the Fed chair watching inflation. Anybody remember all the inflation woes of 2025? I've never seen so many people pay attention to when the Fed chair speaks as I did in 2025. Is he going to cut rates? Are they going to raise rates? Are they going to hold rates? And the impact that it then had on the market. And many schools of thought on that. That's not what we're here to talk about. But one reason why the rate cuts were such a concern for the Fed was because of this chart. It wasn't the first time the Fed had been in this position. They were in the same position back in the mid-70s through the end of the 70s, into the early 80s, when this gray line, inflation ran up, right? They started cutting rates, or they chased it with rates, and then they started cutting, which brought it down. But then you had a dramatic rebound, here in 78, 79, 80, and that's when they brought Paul Volcker back in from retirement, and his efforts to deal with it were necessary but extremely painful, right? So the Fed chair now, Jerome Powell, is nervous about that. He doesn't want that rebound inflation like we saw back in the 70s. So they've been very cautious. And that was a big piece of how we invested in 2025. Because of how the Fed chair was dealing with whether to cut or raise or hold interest rates. But the good news is so far, as we see in this blue line, the inflation continues down, which is good for us, right? Even though the Fed is meeting today. So today I think it's 1:30 our time, 2:30 Eastern. We'll find out, are they going to raise, they're going to drop, they're going to hold rates. But the good news for all our investments is that it does seem like core CPI continues to come down, and hopefully, we'll avoid any type of big run up there. So that brings us to bonds, okay? Bonds are, and I'm talking about corporate investment grade bonds, right? Are in the worst drawdown that they've ever been in the history of the bond market. And we really see that exhibited in this chart because 78% of publicly traded bonds, or again, corporate investment grade bonds, are yielding less than 5%. Because what's the other term we use for bonds? Fixed income, right? We use bonds theoretically as a hedge, as a quote-unquote safe investment, even though in 22, investment grade bonds lost somewhere between 13 to 15%. That's a problem, right? If we're calling it a safe investment. But now, bonds have not come back. 78% are yielding less than 5%. If we're using it as a fixed income instrument, that's not a good number, right? Getting less than 5%. 59% of investment grade bonds are yielding less than 4%. I can get less than 4%, between 3 and 4% in a money market fund, right? So what this chart is telling me is that bonds continue to carry risk without the return. Does that mean they'll always be that way? That they'll never ever be a good investment again that doesn't give us a decent return? No, but that's how it is for right now. So remember, we're looking at diversification and risk management. Bonds we have to take into account. So everything we've talked about so far, the S&P 500, the Russell, global, we looked at inflation, we looked at bonds. Those are all market related, right? There are market factors that go into how all those instruments perform. But one thing we have to take into account moving forward is the noise that has absolutely nothing to do with market fundamentals. And it is beyond frustrating. Case in point, we all in this room lived through the 20% tariff drawdown that started in February of 25 and theoretically ended in June, hit the bottom in April, right? 100% noise. And the reason why I feel 100% confident in saying it was nothing but noise is because if you look at the chart, it's what we call a V bottom. As soon as the noise went away, the market came right back to where we were and has continued to churn. So, the noise, the politics, all those things that have nothing to do with market fundamentals. Again, it's something we have to take into account because were y'all okay with that 20% drawdown at the beginning of 25? You are now because you ended up with a good return. But at that point in time, I was getting phone calls. Hey, what's going on? What's happening here? We got a 20% drawdown. It's noise. But again, it's something we take into account when we're talking about diversification and managing our risk. So, what's the market going to do moving forward? Those of you who've attended State of the Markets, I'm sure y'all are used to seeing this chart every year, right? Let's go ask the experts. So, and you can see 5 of the last 6 years, they've missed it. But finally in 2025, bless their hearts, they finally got one right, 1 for 6. Would you have the guy that bats 1 for 6 on your baseball team? Absolutely not. So we can't rely on these guys to help us to know what the market's going to do moving forward. So what do? As you all know, we start here at Cloud with managing risk first. Okay? And Mr. Aaron Howard is going to tell us more about that.
Thanks, John Michael. Well, all right. So John Michael kind of told us a little bit about what's currently going on in the markets today. And I'm going to zoom out a little bit. And as he said, really get to fundamentals and the kind of the reason why we do what we do. Again, if you've come to these before, you've seen these charts, but I think they're very important for us to remember. And we get to start with the game. So by show of hands, so you got 4 funds on the screen, and these are 4 funds representing 4 market indices. And so this is based on real numbers. And we're looking at a 3-year return period where each bar represents 1 year. And so you can see, each fund has a different kind of a return profile. So Fund 1, good year, bad year, good year. Fund 2, 3 good years. Fund 3, 2 bad years and a good year. Fund 4, 3 good years. So given that, obviously we don't know much, but given that, nobody shout out if you know the answer. What fund would you choose, right? Who would choose Fund 1? Nobody. We got one. Who would choose Fund 2? Okay, yeah, I like that one. Who would choose Fund 3? Nobody. What about Fund 4? Yeah, right. That's what we expect. That with the limited amount of data that we have, those are logical choices, right? But the point here is that using limited performance-only metrics is never a good option, right? But let's be honest, how many times have you got, I know y'all probably wouldn't do it, but some people, even when you look at a 401k for investment, and what do? You go out to the 1 year and the 3 year and the 5 year and you compare and you say, okay, well, these two are large cap, but this one did better, so we'll go with that one because if it worked then, it should work again, right? And what the point of this chart is to say, the things that drove the market performance in past years are not guaranteed to drive it in future years, right? That's the little fast talker guy at the end of those commercials. Past performance is no guarantee of future performance, right? And so what we see is the funds that we thought looked the best actually performed the worst in future years. Now, does that mean that is going to happen again? No, right? But what I'm here to remind you of is, a lot of people, myself included, it's very easy to, when we have several good years in a row of positive growth and positive market performance, it's easy to think that we're out of the woods. I think John Michael even had a slide, are we out of the woods, right? And my point here is just to remember that just because things are going well, even if indicators look good, we always have to maintain our composure. We can't say, okay, things are going good, let's take our foot off the gas and let's coast because the risk is gone, right? The risk is still there, and that's why we focus so much on risk first. Our objective is to keep you on track, right? And even just a simple chart like this chart is showing you the average investor versus the indice or the benchmark that they are supposed to be tracking, okay? And so the benchmark is here, the S&P 500. An equity investor who's investing in the same stuff doesn't actually get S&P returns, and the difference is almost always behavioral bias. What that means is if we're not careful, our actions of when we buy and sell based on our emotions, which John Michael just told us are driving the market in many cases, will lead to, statistically, underperformance. And so it's our job to make sure that we're not acting emotionally, either on the positive or the negative, right? And so just remembering kind of the history of the markets, this chart looks at 40+% drawdowns or bear markets in the S&P 500. And what you see is these triangles represent the period of a positive bull market. The red dotted lines represent the beginning of that bear market correction or crash of that 40+%. What's interesting here is the rhythm or the kind of the rationale of when this happens seems to be fairly random, right? So the first one was 5 years till another one happened. Then it was 36 years, so really long run up. Then it was 28 years, then it was 6 years again. Currently we're at about 17 years. And so what does this mean? I mean, it means that these type of corrections, they are an essential part of the markets that we are investing in. That it's not a flaw in the market, it's just part of the market experience is we will have corrections from time to time, because just in the word itself, correction is getting the market back to the appropriate levels. And all this chart is telling us is that there isn't a way we can predict what's coming. We have to always be on our guard. We have to always be ready so that when something like this comes, as it inevitably will, we're going to be prepared for it. And the reason we need to be prepared for it is because of what happens when those events take place, right? These gray bars, if you can see, with the years above, represent lost decades in the market. And you're probably familiar with the term, but a lost decade represents a time period where if you were holding investments in the S&P 500, right? If you're holding investments in the S&P 500 and there's a correction, that the correction is so strong that even after the market starts to go back up, it would take at least 10 years to get back to where you started. Another way I like to put this is if we're sitting here in 1966, give or take, right? It would have taken, I use 1966 to get to 1980, right? It would have taken 14 years to get back to even. So another way to say that is if you had cash in your mattress, it would have done the same amount that the S&P did over a 14-year period. Okay? This is important to remember, because if we forget and we're allured by the positive growth in the market, and again, I'm not saying that one of these is coming next week. I don't know. Right? But if we're allured by the positivity in the market, we can forget that one significant drawdown can literally take years and years and years to recover. And of course, I know who I'm talking to. Many of us don't want to wait for 10 years for our money to come back, right? Because then it might be going to our kids. Okay? So this is important, right? It's very important that we're always aware so that we're never going to experience this. And of course, there's no guarantees, but that's why we want to focus on risk and why it's always important for us to continue to monitor that no matter how we feel in the moment. This is one area where in the fixed income side, we looked at the S&P, now we're looking at fixed income. On the fixed income side, John Michael mentioned this, that we're in the longest drawdown for the U.S. Bloomberg Aggregate Bond Index, or investment grade corporate bonds in history. We're in a 5-year drawdown. And we had a strong year last year in the corporate bond market. That was a good indication. But again, you look at this as that kind of cash to cash ratio. If you had been holding cash for these 5 years, you would be actually positive because money markets are paying better, right? And the big takeaway that I personally have for this is if it happened, when this event happened, many of you were in this room, we talked about it. It was called a black swan event. And from a statistical standpoint, it means it's more likely you'd get struck twice by lightning than that this would have happened. Because not just that the bond market goes down, but that it went down in correlation with the stock market, that they went down together.
They're usually opposites.
Correct. They're usually opposites. That's why bonds have been traditionally known as a ballast and a conservative investment in your portfolio to keep things, safer, right? And so what we saw is they went down together, and since then, you'll see on the next chart, they've maintained that correlation. And so what this tells me is it doesn't necessarily say it will happen, but it means it could happen. It could happen again. And so it's important that we know, okay, not only do we have to manage risk, but this chart is showing us we might have to manage it in a different or unique way than we have in the past. And Charlie's going to talk more about that. With my last slide, I just want to reiterate what I just said, which is, back here, when this kind of correlation started, you see, let me explain the chart. I got too excited there. So this line is representing the correlation between bonds and equities, or the S&P and the AGG, right? And when it's going down, especially when it's under this level, that's showing a negative correlation. In other words, when one goes up, one goes down, right? And that's actually a good thing in a diversified portfolio, Because when one side of your portfolio is going down, you would want the other side to be going up, right? That's what gives it some conservative bounce to it. And so what we see is this extreme shift or reversion from a negative correlation to a positive correlation that has only intensified. And even though it has dropped a little bit, we're still on the positive side of this correlation. And so what that means from a market perspective is, it would be expected that if the S&P goes down, that the bond market would also go down. And that's dangerous from a risk management standpoint. So that's something that we are keeping an eye on and making sure to manage that risk. So again, I'm not the doom and gloom guy, okay, right? Because we are doing things, especially within our portfolios, to try to improve those, that when we are going up with the portion of funds that we have allocated to the market, that we're trying to optimize that. Many of you have seen some of that. We've talked about that in individual conversations and reviews. And so we still want to participate in the upside as long as the market continues to go up. But we also don't want to take our foot, off the gas, or maybe to say it a different way, we don't want to kind of just sit back and relax and say, okay, things are good now. We want to always be diligent and aware and cognizant that, hey, we need to monitor risk no matter how we're feeling, no matter how many, double-digit returns we get from the market. And so Charlie's going to talk about how we are specifically going to kind of continue to do that. And so I'll go ahead and turn it over to him.
Did you have a ring?
Oh, yeah.
All right. So before I dive in, I was just going to kind of, when Aaron was talking through this chart, just kind of add some different things, because obviously with how the markets have ran, we get a lot of questions about, hey, what do we expect this year? Is there going to, are you anticipating any type of significant event? And this is obviously painting, the picture of what we all fear, right? A lost decade, a lost 10 years in the stock market. That's something that we all fear. We haven't had that since, basically the tech bubble, the financial crisis type time frame. But it's also important to remember that when we start defining like drawdown and risk and volatility, we always expect volatility, okay? So on average, the S&P 500 drops 10% every 12 months. So when we get asked that question, a lot of the times it's, well, what do you mean by it, right? Do I expect the market to drop by 10% over the next 12 months? My answer would be yes, because historically that's what it's done. On average, it's every 12 months we see a 10% pullback. And like Aaron said, sometimes that can be a healthy thing. If we think past this time frame, right, which has been somewhat recent, so past this lost decade, you can point to 2018. We had trade tensions. The market dropped in excess of 15%. We had 2020, right? COVID, market dropped 30% in 30 days. We had 2022, where we had crazy inflation and them raising rates faster than they ever have. The market dropped by 25%, right? We had 2025, like John Michael talked about, the tariffs, where the markets dropped in excess of 15%. So when you look at those events, if you notice, every one of those events I talked about, we can say that. This happened, so we saw the markets fall by this. This happened, we saw the markets fall by this. With those 10% corrections, they happen so frequently, there's not like a triggering moment that you can say, right? Sometimes there is, but a lot of the times that's just part of being invested, okay? So as we talk about this volatility, and Aaron goes through kind of the doom and gloom, like he said, it's important for us to remember that volatility does exist when we invest in the markets. And I just kind of wanted to put some color to that. The beautiful thing about 2018, 2020, 2022, 2025 is those were very short-lived corrections, right? I mean, I think everybody in here would take 30% down and then 90 days back to even all day long over 10 years of nothingness, right? I mean, it's scary when it happens, but when it happens so quick, then we can kind of get back on that train and see our money start growing again. So I just wanted to add a little bit of color to that. So kind of not spending too much time on here, but it's just kind of the thought process of we can't just do things the way that we've always done. And Aaron hit a big reason on that, dealing with bonds, right? If we just take the same approach we've always taken, basically we're kind of burying our head in the sand. We've got to be innovative. We've got to look for opportunities. We've got to be able to identify, just because this has happened in the past, it doesn't mean it's going to continue to happen. So what are the risks associated with certain investments, and what are things we can do proactively to try to help mitigate that? Just kind of a very simple example, at the end of the day, if we focus on drawdown risk and we can preserve capital, it's much easier to recover. So if you had $100,000 and you lost 22% versus having $100,000 and losing 28, right? You're basically looking at needing half the return, okay, to get to the same spot. So in this scenario, if you lose 22 and you make 8, you're at 84,000. You lose 28, you make 16, which is double the return. You're actually at a little bit lower of a spot. So that's just kind of a simple example to say anything that we can do proactively to try to mitigate some of these losses is just going to make it that much easier for us to get back to where we started. So that's one of the biggest reasons why we focus on that drawdown risk and things we can do to proactively try to mitigate that. Going to Aaron's conversation regarding bonds, this is something that probably all of y'all have heard us speak to, but it's important to differentiate between public debt and private debt. So best way to say what public debt is things like Apple, Google, IBM. Those are those corporate bonds that Aaron was talking about. Those large companies can raise money by issuing debt, okay? After 2008, when regulations got super tight, the area that hurt the most was small to medium-sized companies. For them to get money from banks, things like that, it takes a long process, a lot of due diligence is done, so they can't get money as quickly as those big companies. So that's where private debt became a huge space, is for small to medium-sized companies in order to gain capital to grow their businesses. There's all kinds of private debt that you can do, okay? That area is very unique in that it doesn't move the same way that public debt moves. So you can look at COVID as an example, okay? During COVID, high yield bonds down 21%, leveraged loans down 22%, investment grade bonds down 6.3%. Private debt as a sector was down about 4.8%, okay? So lost a little bit, but obviously was one of the better performers in the debt space. You go to the inflation hikes. This is the time frame where Aaron was showing you that 18% drawdown, right? Investment grade bonds, which is the staple, for the 60-40 allocation. As we get older, we shift our money from stocks to bonds, more specifically from stocks to investment grade bonds, lost 18% during that period. Okay, this was the anomaly that Aaron was speaking to. High yield bonds, leveraged loans also suffered. Private debt, zero drawdown. Okay, because private debt is not interest rate sensitive. Okay, private debt is more default sensitive. So this is just kind of showing that, going back to the first slide I had, if we just do things the way that has always been done, right, you'd be looking at this. Whereas there's other places that you can go, right, that act differently in different market environments. A lot going on here. But this is just showing historical volatility of private debt compared to other places. So obviously, if you look, this is kind of risk, return, okay? So obviously, you want to be as far as you can over here and as high as you can up here, right? That's showing we're taking low risk but getting high returns. So you can see private debt as a whole is kind of your lower risk opportunity. Traditionally, right, 60% stocks, 40% bonds, okay? This is showing kind of an efficiency frontier where basically as you're looking, you've got less risk moving this way, more return coming this way. And if you look, typically it's been 100% stocks, and as you start introducing bonds, you lower your return, but you're lowering your risk, lower return, lower in risk, and then the curve moved this way to where we're 100% bonds, okay? On this efficiency frontier is basically shown by adding in private debt what ends up happening. So you actually end up moving to the left, which means lower risk, but it's actually sloping up, giving us higher returns. Okay? In other words, that looks a whole lot more efficient, right? That looks a whole lot more efficient. So that's where that 60% stock, 40% private debt, up in the upper left is kind of showing you how that plays out when you start introducing, new investment opportunities. Kind of the last thing I'll add to this, like if you look at 2025, that private debt piece, 7.7%, right? So you've got an asset that's, basically no NAV movement, yielding about 7.7%. So it's been doing its job, adding a whole lot of value to the portfolio, really diluting that risk, but also giving, very, very strong returns. So that is all that I've got in my slides. So I think we're doing pretty good on time. So yeah, that's perfect on time. So we'll open it up for any questions that you guys have regarding any of this material or anything else on y'all's mind.
I have one question.
Yes, sir.
So you touch bases on tariff and call it a noise. Okay?
Yep, John Michael, yep.
And the market went down. Why did the bonds go down? Because the money is coming to the government.
During the tariffs?
Yes.
So I'd have to look specifically during that short time. I don't think bonds really reacted like stocks did during that time, right? So during the tariffs, right, you got to think that was like new information. Hey, we're raising tariffs like crazy. Unknown, right? So the stock market reacted incredibly quickly. During that time, and I'd have to pull data, bonds did not react like that, right? So bonds, you didn't see any type of major pullback, anything like that. So just the unknown of that caused huge movements in the stock market. What typically is going to cause the movements in that bond market is kind of like what we just showed, is those interest rate hikes. That's really what caused those bonds to deteriorate quickly. Yeah. So really the tariffs didn't have a big impact on that. Yeah. Yes, sir.
So for the cloud funds, can you go over the distribution of the asset classes?
Yes, I don't have a slide doing that. So are you talking large cap, small cap, international,
Yeah.
that type?
Yeah.
Yep. Yeah. So I would say this on the fixed income side, and let me do some math in my head real quick. On the fixed income side, you're probably at about 60% private debt, 40% public debt, if that makes sense. So if you've got an allocation that's in fixed income, probably 60% of that's going to be in private debt, 40% is going to be in public debt, okay? So it kind of sounded like we might be slamming public debt as it's the worst place to be. Last year, public debt did fine, right? Don't want to put all of our eggs in one basket. Understand that there's times when public debt does good. Public debt is also fully liquid, right? So there's advantages to that. So that's probably a good breakdown of that. And within the public debt side, majority of it's going to be short term, but there is a little bit of long-term exposure. And y'all can help me with this. On the equity side of things, you're probably looking at more like 8% international, probably 12% to 15% small to mid, and then the rest large cap. And then within there, in the large cap side, probably split pretty evenly between growth and value right now. Split pretty evenly between those. Yep. Any other questions? Yes, sir.
You guys take advantage of these large drawdowns? move something from public debt to go grab the S&P 500 kind of stuff?
Yeah.
Drawdowns?
Yes, and I mean, I think that probably the best way to do that is like through rebalancing activities, right? I think one of the big things is like, if you have a specific conversation with your advisor and says, hey, like, as you're having that review and you're strategizing, hey, like, we think markets are super high right now. We want to allocate a certain amount to cash. And if we get a drawdown, let's look at maybe taking advantage of that opportunity. That's kind of an individualized conversation.
There's no automatic, hey, we had a big 15% drop, let's move some money out of bonds.
From a rebalance perspective, yes. So we would rebalance, which essentially would do what you're saying. So if you were 60-40 and the market took a big dive, you're probably the value of your bonds has gone up, right? And the value of stocks has gone down. So if you rebalance back to 60-40, that's going to kind of be taking advantage of that. But from the standpoint of, hey, you're in a 60-40 portfolio, the market drops like crazy, we're going to take 20% of your bonds and throw them into stocks.
To keep that balance running.
Yeah, we would not increase someone's risk posture in that manner because we haven't talked about it, right? So like a super conservative client, if we did that for them, you know what I mean? Does that make sense? So we would typically do that through like a rebalance activity.
I didn't know if I know some of your funds are more risky than others.
Yeah.
I don't know if the more risky ones did that kind of thing.
Right. No. So some of them can, yes. Some of them can in an individual basis, yes. I thought you just meant as a whole, right?
I didn't know which, I know some funds are more risky than others.
Yes. Yes. Yep.
Like 35% on significant money on this April thing.
Right.
I've still got it.
Yep. Yep.
It's incredible.
Mm-hmm.
I didn't know if you guys could take advantage of that.
Yes, to some degree. Some of it gets a little bit trickier with like keeping clients within risk tolerance and things like that. So a lot of the big opportunities there are like done on, and I don't know if I would call it luck, but like, hey, you have a review. Hey, I'm willing to keep $100,000 sitting in cash and, let's wait for that next 20% pullback and then have a conversation, right? Yep. Any other questions?
That's like Warren Buffett.
Yeah, there you go. That's right.
I
Yeah.
don't know, $100 billion
Yeah.
in cash.
Yeah. Just ready for those opportunities.
Well, and Charlie kind of brought this up. It all goes back to your initial risk tolerance, right? So when we deal with risk up front, we come up with a plan. And so your plan, you may have an opportunity to take advantage of something like that if the opportunity comes along. But for other people, if we have built out that plan to be low risk, we talk all the time about making sure your dollars last as long as you do, right? So
Right.
if we have a very specific strategic plan to make sure our money lasts, we may not want to try to take advantage of some type of pullback and an opportunity to slide into something with higher risk.
Well, it also matters how much money you got to play with. You want a
Yeah.
base.
Absolutely.
You want a base
Yeah.
that you don't play with.
Yeah.
So that's why we
For me,
wouldn't
that's
do
you
it.
guys.
Yeah.
Stuff
Yeah.
I'm playing with is
Yeah.
real good because I'm jumping in these
Yeah.
black swan events.
Yeah. Yeah.
Yeah.
Yeah.
So that's why we wouldn't do it wholesale as a firm.
Yeah.
Does that make sense?
Yeah. Yeah.
So this is a weird question.
I love it.
So you mentioned plan. You're going in a certain strategic towards a direction. And then the market, the 60-40 changes. Let's say 50-50.
Mhm.
You're not the guys over there sitting in front of the TV and watching that all the time, right? You do have some software that actually helps you take care of these red flags.
Yeah, no, I mean, we definitely have software that, we're monitoring the portfolios and looking at balances and or distributions and things like that, right? And so typically we're rebalancing quarterly, but, if there is some type of major event where it's like, hey, now the 60-40 is 50-50, we can make that strategic decision that says, hey, let's go ahead and rebalance because now we've got some opportunities to shed some of these, positions that have held their head up and get into some of these positions that, have lost a little bit, get back to that 60-40. So yes. So we've got software, we've got tools, all that, where we're monitoring them and being able to do that. Yep.
So if I get a email from Don Cloud, he's mine.
Yeah.
So he has already consulted everybody
Yep.
before he called me to look into this certain area.
Well, and I think what you're talking about, like when you mentioned the 60/40, those type changes are macro level, right? So it's not like the tariff stuff and in 2 months we're down 20%, and are we going to make a change? Those are broad market macro trends. And, we started moving really in 22 and 23 into the private debt because we were seeing that macro trend. So it kind of depends on if we're talking about equities and a pullback like the discussion we just had versus something that has a much, we've been seeing this trend coming, right? And we've got a ton of analysis and it's not a decision we've got to make overnight. But yes, there's a lot that goes into any type of recommendation and change.
So once you make a recommendation, all the things are already in place. That's when you start calling people.
Yeah, well, like the example you brought up, if Don calls you and has a conversation, yeah, that conversation, that recommendation is coming based on data. Yeah, not opinion or emotion.
Yeah.
Yeah.
So,
Yes, sir.
What are examples of the private real estate debt?
Yeah, so the biggest example and the one that we're primarily using right now is basically think about first lien positions. So in the private debt space, just like any space, right? Like it's all risk return, characteristics. So when you're looking here, you've got all these different things, right? All these different areas. And so the area that we're focusing on right now is first lien positions, which basically mean you're not owning any piece of real estate. You're owning the first lien position on it. So you are loaning the money to do the improvement, whatever it might be. So you are in the lowest risk position in that deal, right? You don't have equity ownership. So if the price of the property goes up and down, you don't experience any benefit of that. You basically are just sitting there collecting, monthly interest payments for loaning that money out. And if there's ever a default, you own the property, right? So it's all first lien positions right now.
So it's basically, when somebody goes to build a building, they borrow money,
Yep,
and that would be
the first lien position. That's right.
position.
Yes, sir. Yep,
You're not being necessarily a landlord or
correct.
you're
Yep, and they're all very short term.
yeah. I'm saying
Yep.
it only goes up in 18 months or whatever.
Yep, that's exactly right. Yep. Yep. And they're all built with, this is kind of a big question we get with private debt is, well, they're dropping interest rates, so how does that affect it, right? So all of the deals, number one, they have terms on them. So, let's say it's an 18-month term. Well, you're kind of locked in at 18 months, and typically there's floors, right, they're all variable rates. It's kind of like if you go get a HELOC on your house, it's going to be, SOFR plus, 1.5 or something like that. So it's the same deal, right? It's a floating rate, but all of them have floors. Floors. So what it would mean is, that they might be collecting 11% today. Well, as rates start dropping, the SOFR plus could mean that rate could be 9%, but there's a floor of 10. It can never go below 10. Okay, so over time, as rates drop, you could see private debt rates start going down, but they always carry, excess return over public debt, and typically that's 3 to 4%. I like to give people the analogy of like today, you can go out and get a CD paying what, 4.5, we'll call it. Well, that private debt right now is paying 7.5, right? So that's good, but it's also pretty attractive to get a 4.5% CD. When CDs were paying 0, prior to 2020, and private debt was paying 5.5, I'd argue that might be more attractive, right? Even though it's lower, just for what's available in the market, that might be a little bit more attractive. So you will see them come down as if rates continue to come down, and especially if long-term rates come down. But right now, they're holding steady. Yep.
Steve, do you have another question?
yeah, so here's put you on the spot question.
Yeah.
Based on today, what is your outlook for 2026? Because in the last quarter of last year, we saw a lot of there was a lot of manufacturing starts, a lot of processing plant starts, the inflation rates kind of stable.
Yep.
A lot of optimism in the administration and a lot of the
Yeah.
investment markets. What's your outlook?
So I don't know if I would say this is my outlook. I would say if you look at them cutting rates right now, right? Are mortgage rates coming down? Little bit, right? But if you look at like the divergence in that, so typically when rates come down, you see long-term rates start coming down. This is like another like anomaly where across history, when they've cut rates like this, long-term rates have never held like they have before, right? And so you think, why do long-term rates hold? Well, long-term rates are market dependent. Long-term rates are built on supply and demand. And so really, in my opinion, and I mean, this might not be opinion, this might just be more kind of factual, is, you know, why long-term rates are staying up. There's really two drivers for that. Is number one, people are encouraged with the economy. They feel good about the economy. So to lock up your money for a long period of time, you've got to have a much higher rate to agree to do that, right? And also, you expect inflation may kick up, or you're concerned about inflation. Okay, you don't want to go lock your money up in a long-term rate if you expect inflation could spike again. So, in my opinion, I think that, and I've been saying this for a couple years now, I think if they can keep inflation under control during this rate cutting cycle, I feel really good about the economy. I mean, that's my opinion. I don't know if you want to add anything to that.
Well, if we go back, you remember the chart talking about, is okay. Way back. The chart talking about the Russell 2000. One reason why the Russell 2000 has outperformed, at least to this point in 2026, and I know we're only, not even a full month in, but end of 25, beginning of 26, those small cap companies are very dependent on cash flow and rates coming down. And so you're already starting to see, at least from that index and in that market sector, you're already starting to see a growth. Now, is that going to continue? We don't know, but don't have a crystal ball, all that. But, I'm kind of like Charlie he approached it kind of from the rate standpoint, from the economic stability standpoint, and the growth of a lot of these companies that underperformed in 05 or 25, I'm seeing good signs that make me optimistic about continued growth. Maybe not in the Mag 7, you're starting to see consolidation and that money spreading out, but then if you get continued growth from all those that have been underperforming, that can lead to a lot of growth.